If you own shares, or you're planning to, the May 2026 budget just changed the rules on you. The 50% capital gains tax discount, it's being replaced. And depending on who you are and what you hold, your tax bill on selling shares could nearly double, or in some cases, barely change at all. In the next few minutes, I'm going to show you exactly how the new rules work with real numbers so you can see where you'd land. No jargon. Let's get into it. First, let's be clear on what we're losing because you need this to understand what's changing. Right now, if you buy shares and hold them for more than 12 months, then sell at a profit. Only half of that profit gets taxed. So if you made a $30,000 gain, only $15,000 gets added to your income. The other $15,000 is tax-free. That's the 50% discount, and it's been around since 1999. It's simple and it's generous. It doesn't care if you held for 13 months or 13 years. It doesn't care about inflation. Half your gain gone from the tax calculation. That is the system that's going away. Here's what replaces it starting the 1st of July, 2027. Two changes working together. Change number 1, indexation. Instead of automatically halving your gain, the new system adjusts your purchase price for inflation. The idea is you should only be taxed on your real gain, the part that actually beat inflation. If your shares went up 3%, but inflation was 3%, you haven't really gotten richer, so you shouldn't be taxed as if you had. Change number 2, a minimum 30% tax rate on capital gains. No matter what your tax bracket is, the effective tax rate on your gain can't drop below 30%. So that's the new world. Your gain gets shrunk by inflation, then what's left is taxed at your normal rate, but never less than 30%. One important note before we go further. This is grandfathered by timing. Shares you already hold before the 1st of July 2027. The gain up to that date still gets the old 50% treatment. Only the gain after that date falls under the new rules. So existing holdings get a transitional split. Now here's the part most coverage gets wrong. This change does not hit everyone the same way. Whether the new system is worse for you, or honestly, sometimes better, depends on two things. 1, how fast your shares grew compared to inflation. And 2, what tax bracket you're in. Let me show you 3 real examples. Watch how different they are. Example 1. You're a high earner. Top tax bracket, 45%. You bought $20,000 of shares. You sell them for $50,000. That's a $30,000 gross gain. Let's say inflation over your holding period added up to about 10%. Under the old system, half the gain is taxed, so $15,000 at 45%. Your tax bill, $6,750. Under the new system, inflation lifts your $20,000 cost base to about $22,000. So your real gain is $50,000 minus $22,000. That's $28,000. Taxed at 45%, $12,600. Same trade. Your tax bill went from $6,750 to $12,600. It nearly doubled. Why? Because inflation only sheltered $2,000 of a $30,000 gain. The rest is now taxed at full rate instead of half. If you're a high earner holding growth shares, this one stings. Example 2. This one's counterintuitive. Stay with me. You're a lower earner, 16% tax bracket, income under $45,000. Same trade. $20,000 in, $50,000 out, $30,000 gain. Under the old system, $15,000 taxed at 16%. Tax bill, just $2,400. Under the new system, your real gain is $28,000. At 16%, that's only about a 15% effective rate. But remember the 30% minimum floor. So a top-up kicks in to bring you up to 30%. 30% of $28,000 is roughly $8,400. From $2,400 to $8,400. That's more than triple. The floor is designed to stop low bracket investors paying very little. So proportionally, the lower earner here actually takes the bigger hit. Surprising, but that's how the floor works. Example 3. And this is where the new system is actually kinder. Imagine shares that barely beat inflation. You buy $20,000 worth. You hold them a long time. Long enough that inflation totals 40%. You sell for $30,000. Inflation lifts your cost base to $28,000. So your real gain? Just $2,000. Old system, $10,000 gross gain, half taxed at 45%. About $2,250. New system. Real gain is only $2,000. After the 30% floor, about $600. The new system is better here. Because most of that gain was just inflation, indexation strips it away, and there's almost nothing real left to tax. This is exactly the kind of investing the new design rewards. Long holds, modest real growth. So let's pull it together. 3 patterns. 1. The new system punishes big, fast gains. The high growth stock that triples in a few years, you'll be taxed close to your full rate instead of half. 2. It punishes lower bracket investors through that 30% floor. They lose the cheap effective rate the old discount gave them. 3. It rewards long, steady holds. The more inflation builds up relative to your actual gain, the more it shelters you. The shape of it is this. If you're a higher earner holding growth shares, expect a noticeably bigger tax bill. If you hold steady, slow-growing shares for the long term, you might barely notice or even come out ahead. Okay, so that's the problem. Now the part you actually came here for, what can you do to reduce how hard this hits you? I want to be really clear up front. This is not about dodging tax or finding loopholes. These are legitimate, well-established ways of structuring and choosing investments. The tax tail shouldn't wag the investment dog, but it'd be silly to ignore the rules either. Here are 4 things worth understanding. 1. Superannuation just got more attractive. Here's a big one. Super was completely left out of these capital gains tax changes. It wasn't touched. That means super stays one of the most tax-effective places to invest in Australia. And relatively speaking, it just got more attractive because the alternatives outside super got worse. In practical terms, that points people toward things like making the most of concessional contributions and looking at unused carry-forward contributions before they expire. And once money is in the pension phase, earnings there are tax-free up to the transfer balance cap. But 2 honest catches. If you're aiming to retire early, you still need investments outside super to bridge the gap until you can access it. Super locks your money up until preservation age. And the government has shown it's willing to change super rules too. So this isn't a magic bullet. It's one tool, and the contribution caps and rules are worth checking with an advisor for your situation. 2. The type of asset you hold now matters more. Think back to example 3. The new system is gentler on assets where the real gain, the bit above inflation, is smaller. That changes the maths a little on the classic growth versus income question. A lower growth, dividend-focused share, or ETF, has more of its return coming as dividends. And dividends are taxed at your marginal rate, not hit by the 30% capital gains floor. They may also carry franking credits. And with income-focused holdings, you're often not selling them anyway, so the capital gains change touches them less. But don't overcorrect. Growth assets still have a real place. And there's a flip side. While you're still working and earning a salary, dividend income stacks on top of your income and gets taxed at your full rate every year. Income-heavy portfolios tend to shine after you stop working, not during. So this is a nuance to weigh, not a rule to blindly follow. 3. Structure. Companies versus trusts. This one's mainly for business owners and people investing through entities. A lot of people historically used family trusts, partly for flexibility and partly because the trust could still pass through that 50% capital gains discount. With the discount gone and a 30% minimum applying, that particular trust advantage largely disappears. Company structures work differently. A company pays tax internally, and that tax generates franking credits. So when profits are eventually paid out to you, you get credit for tax already paid, avoiding double taxation. For a business owner, that can make a company a more sensible vehicle for holding investments long-term than it used to be. Big caveat here. Choosing between a company, a trust, or holding investments in your own name is a genuinely complex decision with a lot of moving parts. Asset protection, your income, your family situation, setup, and running costs. This is firmly go see an accountant territory. I'm flagging it so you know to ask the question, not so you restructure tomorrow. 4. Timing and the 2027 line. Remember the grandfathering. Gains on your existing investments up to the 30th of June. 2027, keep the old 50% discount. Only gains after that fall under the new rules. That makes the timing of buying and selling a more deliberate decision than it used to be. But, and this is important, don't let that tip you into panic selling good investments just to beat a date. Selling triggers tax now, costs you future compounding, and may not be in your interest at all. The point is to make the timing decision consciously, ideally with advice, not to rush. And honestly, the biggest mistake here isn't picking the wrong structure. It's letting a tax change scare you out of investing altogether. A higher tax on a gain is still a gain. Staying out of the market entirely costs you far more over time than this tax change does. The move is to be more strategic, not to stop. 2 quick but important things before you go. First, my examples are simplified to show you the logic. Real calculations use an official inflation figure set year by year. Your gain stacks on top of your other income, and capital losses can offset gains. The numbers move around. The principle is what matters. And second, I'm not a financial advisor, and this isn't financial advice. These rules are still being legislated, and details can change before July 2027. Before you make any decision to buy or sell based on this, talk to a qualified accountant or financial advisor who can run your actual numbers. If this helped clear things up, hit like and subscribe. Thanks for watching. I'll see you in the next one.